Greetings and welcome to my YouTube channel. Today I'll be helping you to prepare general journal using the perpetual inventory system or inventory method, right? So here is our answer sheet, general journal format there. And then without any waste of time, let's go straight to the transactions. The following information is found in the books of Indiana traders in February 2019. They use perpetual inventory system. Markup is 25% on selling price, right? Let's go straight to transaction number one. Transaction number one says received an invoice for goods bought from BB wholesalers for 28,500, right? So here, this transaction means that you have bought goods on credit, right, from your supplier BB wholesalers. So to analyze this transaction, because it's not directly saying you've bought goods on credit, it's saying you have received an invoice. So whenever you receive an invoice is a source document that is given to you as a business by your suppliers when you purchase goods on credit. That is why I'm saying this transaction in summary means you bought goods on credit, right? So whenever you've bought goods on credit, two accounts affected is going to be trading inventory and creditors control, or trading inventory and account payable, right? So you're going to debit trading inventory and creditors control or account payable, right? Because whenever you buy goods, inventory is increasing in your business. Day one there, or date the first there, and then you're going to debit trading inventory. Trading inventory, and you're going to credit creditors control, credit creditors control. And credit creditors control by 28,500, and then credit there 28,500, right? And then if the transactions, or maybe in the questions they also requires you to narrate, you're just gonna simply say goods there, goods bought on credit. So a narration is like a summary of what happened on the transaction. You bought goods on credit since you have received an invoice. And remember, an invoice received is a source document that is issued by your creditors, you as a receiver, for purchasing or buying goods on credit. That is why I summarize in a narration form to say goods bought on credit, right? So that is how we record transaction number one. That is how we record transaction number one. And then let's go to transaction number two. Transaction number two. So transaction number two. Transaction number two. Transaction number two. Transaction number two there says issued a cash slip for goods 11,500. So here it basically means you have sold goods for cash. Whenever you issue a cash slip issued, it's a source document that you issue to your clients or your customer whenever you sell goods to them for cash. When you sell goods for cash, you issue a source document called cash slip, right? So this transaction basically means you sold goods for cash, right? So when you sell goods, there's 4 accounts affected since you are using perpetual inventory system. Number one, bank. Number one, bank, because you are receiving money. Bank is an asset, and whenever there's an increase in asset, you debit, right? And then you're gonna credit sales. Sales is an income account. Sales, you credit sales because sales is an income account, right? Sales is an income account, right? And then when you record, you're gonna record the amount of sales of 11,500. Even on the sales, you credit the 11,500. And then after there, you can also put a narration. You can also put a narration that says, sold goods for cash. Sold goods for cash, right? That is your narration there. Sold goods for cash can be a narration. And then you also go and record cost of sales, cost of sales, cost of sales. We're still in transaction number 2. You also have to record cost of sales and trading inventory, because inventory is recorded on its own cost, whether you are buying it or selling, right? So you're going to say trading inventory, trading inventory, and then narration there will be cost of goods sold, cost of goods sold brought into account. Brought into account. So cost of goods sold brought into account. That is narration for number 2. And then narration for number 1 is sold goods for cash, right? And then how do you calculate the cost of goods? Since the transaction or the information tells us that this business uses markup 25% on selling price. So you're gonna say, open brackets there, selling price, which is 11,500, multiplied by 75%, which is the percentage of the cost price. You divide by the percentage of the sales, which is 100. Because remember, whenever you sell goods on a markup of 25% on selling price, or whenever markup is on selling price, the selling price is equals to 100. It means this 11,500 in percentage is equals to 100%. So what we want is 75% in rent value. That's why we say 11,500 multiplied by 75% divided by 100, right? And then how much there is our cost price. Our cost price is going to be 8,625, right? And then even there, we're gonna debit 8,625. You see now, that is how we calculate our cost of sales there, right? Then that is transaction number 2. Let's go to transaction number 3. Transaction number 3 says a check counterfoil for 2,500. This was for a payment to LR Logistics for transporting goods bought on the 1st of February 2019. So you paid a transport fee utilizing a check, because a check counterfoil is a source document that is provided whenever you purchase goods, or maybe whenever you make a payment utilizing a check, right? So two accounts affected here is going to be trading inventory and bank. Why? Because when we are utilizing perpetual inventory system, even the delivery cost of the inventory is called trading inventory, right? Whereas in periodic, remember, in periodic is going to be called carriage on purchases. But in perpetual, every transportation for goods is called goods, which is going to be trading inventory, or transportation for goods is called trading inventory, right? So let's go and record. When we record there, it's going to be trading inventory and bank. So it's going to be trading inventory, and then you credit bank. Credit bank. How much did you pay for? 2,500. 2,500 there. 2,500 there. And then if the transaction requires you to narrate, you're just gonna go there and say delivery cost paid for cash. Delivery cost paid for cash, because check is the same as cash. Check is considered to be cash, right? That's why we say delivery cost paid for cash, right? Okay, so let's go to transaction number 4. Transaction number 4 there, let's see. Transaction number 4, it says a check counterfoil for goods 35,000. Remember, a check counterfoil is a method of payment using a check, right? So it means here this transaction basically means you've purchased goods. You've purchased goods in a form of paying the goods for utilizing a check. You've paid or you've purchased goods utilizing a check method to make a payment, right? So now to record this transaction that says you've purchased goods utilizing a check payment method, there's only 2 accounts affected there, which is going to be trading inventory, because you're purchasing goods, it means you're purchasing more stock. Trading inventory, right? Trading inventory there, trading inventory, and then check is also recognized as cash. Therefore, we're gonna credit our bank account. So it's gonna be bank there, and then when you narrate there, a narration should be bought goods for cash. Remember, check is the same as cash, right? So bought goods for cash, and then when you put an amount there, you bought goods for 35,000. 35,000. 35,000, right? And then let's go to transaction number 5. We can go to transaction number 5 now if we are good with transaction number 4. And then also, if you don't understand, you can put a comment there. I'll be checking and trying to respond to your comment as well, just to help you. Okay, so let's go to transaction number 5. Transaction number 5 says issued an invoice to Deb Enterprises. Issued an invoice to Deb Enterprises. Issued an invoice to Deb Enterprises, right? So issued an invoice to Deb Enterprises. what an invoice issued is a source document that is issued by business to a client whenever they sell goods on credit. So this transaction basically means you sold goods on credit, right? So we've got 4 accounts affected. We're going to have 4 accounts affected because we've issued an invoice, meaning we have sold goods on credit. So 4 accounts affected there. 4 accounts affected there is going to be debtors control, your credit sales, and then you must narrate after the goods sold on credit. That is the narration for that. And then how much is the amount there? The amount will be, how much is the amount there? The amount is 20,000. So let's go to the answer sheet there. Debit debtors control 20,000, and also credit sales 20,000, right? And then we've got what? Cost of sales. We have to determine the cost of sales of the goods sold, right? So when I say cost of sales there, cost of sales there, cost of sales there, and then we credit also trading inventory. That is transaction number 5. Remember, trading inventory. So trading inventory, we're gonna do this calculation, right? This one. So it's gonna be 20,000 multiplied by 75. Remember, the percentage of markup is 25. Therefore, the percentage of the cost of sales is going to be 75%, and then of sales goes to 100. So it's going to be 20,000 multiplied by 75 divided by 100. So 20,000 is the rent amount you have, multiplied by 75%, which is the percentage of the amount you are looking for, divided by 100%, which is the percentage of the 20,000, which is the percentage of the rent value you have. So how much is your cost of sales? There is going to be 15,000. It's going to be 15,000. You're going to debit that 15,000, and then you credit inventory as well, 15,000, right? And then when you narrate there, narration will be cost of goods sold brought into account. So it's going to be the same as this one. Cost of goods sold brought into account. Same there, right? See. So we can go to transaction number 6. So transaction number 6 says received a credit note for 1,200 from BB wholesalers. BB wholesalers are our suppliers, right? And we received a credit note. So a credit note received, it's a source document that we receive from our supplier for returning goods. So this transaction basically means you have returned goods for 1,200 to your supplier, right? So now, whenever you return goods to your supplier, 2 accounts affected is going to be creditors control and the trading inventory, right? And trading inventory. So when we record the transaction number 6, we're going to debit creditors control. We're going to debit creditors control, and then we credit trading inventory. trading inventory, right? Trading inventory, how much? 1,200. 1,200 there. See now. And then narration will be goods returned to a creditor. Goods returned to a creditor or a supplier. Right? You can say a creditor or a supplier. Right? And then that is all for transaction number 6. Let's go to transaction number 7. Transaction number 7 says a voucher for goods donated to the local orphanage 2000, right? Transaction number 7. So whenever we donate goods there, we go to our transaction there, transaction number 7, our answer sheet I mean to say, and then we go to our transaction number 7 there. We're gonna debit donation as an expense, donation, and then we're gonna credit what we donated, which is goods, called trading inventory. Trading inventory, and then of how much? Let's see there. Much was our trading inventory? Our trading inventory was 2,000. 2,000. So come here and say 2,000. There 2,000, and then narration will be donated goods donated goods to orphanage. Donated goods to orphanage. Donated goods to orphanage. Okay, and then that is all for transaction number 7. Let's go to transaction number 8. Let's go to transaction number 8. So transaction number 8 says issued a credit note to Debt Enterprises for 1,800, right? So a credit note issued, it's a source document that is issued by you as a business to your client whenever they return goods, right? So whenever they return goods, we've got 4 accounts affected. We've got 4 accounts affected, right? So like transaction number 8 is a vice versa of transaction number 5, right? So now when we record it there, we're gonna debit what? Debtors allowances. Debtors allowances, and then debtors allowances, and then debtors control. Debtors control, right? And then narration, there will be a debtor returned goods. A debtor or a debtor returned goods. That is a narration, right? Debtor returned goods. And then with how much? 1,800. 1,800. But we also have to determine the cost of sales or the cost of goods returned, right? So when we recorded this one, we're gonna debit trading inventory. Trading inventory, and then credit cost of sales. Remember, I said this is a vice versa of transaction number 5, right? Here the customer was buying. Maybe the customer was not happy, then he returned some goods. If you check the cost of sales and the trading inventory was credited and the cost of sales was debited. Now we're gonna do vice versa. We're gonna debit trading inventory and credit cost of sales. Cost of sales, right? And then we're gonna narrate, right? We're gonna narrate as well here. Narrate. So the narration would be the narration will be cost of goods, cost of goods returned, brought into account. Cost of goods returned brought into account. So now we come here, we're going to calculate the cost of goods utilizing what? The markup principle, which is going to be 1,800 multiplied by 75% out of 100. Out of 100. Then how much is there? It goes to 1,350. That is the cost of goods returned. 1,350. Right. And then the last transaction there, which is transaction number 9. Transaction number 9 says the owner took goods for personal use. The owner took goods for personal use. So the owner took goods for personal use there. We're gonna debit drawings because the owner is making withdrawal there of his investment. So drawings through goods, right? The owner is making withdrawal of investment through goods. So we're gonna debit drawings and credit trading inventory. Right? And then remember they say, let's go back to the transaction there. They say the owner took goods for personal use at a selling price of 2,000. Private use, right? Actually, this transaction you just see like this. The owner took goods for personal use at a selling price of 2,000, right? Okay, and then we debit drawings, we credit trading inventory. Remember, the owner did not buy, we did not sell to the owner, he took. So we have to record goods on their own cost. So it means we must apply markup calculation there as well, which is going to be 2,000 multiplied by 2,000 multiplied by 75 divided by 100, which will give us the cost. Which will give us the cost of the goods. The goods that have been taken by the owner. It will give us the cost for the goods taken by the owner, which is going to be equal to 1,500. Okay, 1,500. Yes, that is our last transaction. And then if we were to narrate it there, we're going to say the owner took goods for private use. That is our narration. The owner took goods for private use. The owner took goods for private use. That is our last transaction. Thank you for watching. And please do not forget to subscribe, like, and share. And also, if there's any transaction you do not understand, please drop a comment and I'll respond to your comment. Thank you very much. Salute.